Welcome to a new video where we analyze stock market behavior using dynamic charts to make it clearer and more accessible for everyone. Today, we will focus on Disney and its financial results for the first quarter of 2025. Throughout this video, you will see a dynamic chart created from the image on the screen, allowing us to visualize Disney's evolution in the stock market. We will analyze its revenue, the performance of its streaming services, and the factors that have influenced its market behavior. Additionally, we will take a deep dive into how the company's strategic decisions could impact its stock value in the future and the role macroeconomic factors play in its overall performance. To understand the significance of these results, we will also compare them to previous quarters and key competitors in the entertainment and streaming sectors. We will examine how Disney's stock has performed in recent years and determine whether the company remains a solid industry leader. Disney reported revenue of $24.69 billion, exceeding analysts' expectations. Additionally, earnings per share stood at $1.40, also surpassing market projections. However, not everything is positive. Its streaming platforms, Disney Plus and ESPN Plus, saw a decline in total subscribers compared to the previous quarter. This result shows that while the company continues to generate solid revenue across various business segments, its streaming division faces significant challenges. It is crucial to understand that the streaming market is highly competitive, with giants like Netflix, Amazon Prime Video, and Apple TV Plus constantly evolving. Disney must find innovative ways to differentiate itself and offer exclusive content that motivates users to maintain their subscriptions. One of the key aspects of this quarter was the performance of Disney's movies at the box office, which indirectly impacted the number of Disney Plus subscribers. Despite the success of some productions, it was not enough to offset the loss of users on the streaming platform. This brings us to a key question: how can Disney continue to grow in such a competitive environment? To understand Disney's current situation, it is essential to look at how its business has evolved over the years. Disney has transformed from a company focused on traditional entertainment into a giant in streaming and theme parks. With key acquisitions like Marvel, Pixar, and Lucasfilm, it has consolidated its dominance in the entertainment industry. However, recent history has been marked by a constant challenge: the growth of its streaming platforms amid fierce competition from Netflix and Amazon Prime Video. Since its launch in 2019, Disney Plus has been a key player in the market, but it now faces new difficulties. The consolidation of multiple streaming services has led to market saturation, making subscriber retention more challenging. Additionally, external factors such as inflation and changes in consumer behavior have impacted the service's profitability. Another important aspect is the evolution of Disney's stock in the market. Over the last 5 years, Disney has experienced highs and lows, largely due to the pandemic, economic recovery, and shifts in entertainment consumption. We will compare its performance with that of other industry giants to better understand its current positioning. The dynamic chart helps us understand this trend. In the last quarter, Disney Plus and ESPN Plus experienced a decline in their user base. Why did this happen? Content strategy adjustments. Disney has made important decisions about what content to keep and what to remove from its catalog, generating mixed reactions among users. The company has removed certain productions from its platform to cut costs and prioritize high-performing content. However, this may have led to subscription cancellations from users who no longer find the content they expected. Pricing and competition. The streaming war remains intense. With subscription price increases and new strategies from rival platforms, some users have opted to cancel or switch to other options. Additionally, the emergence of ad-supported plans has changed how consumers perceive the value of the service. Fewer promotions and discounts. Disney has reduced the promotions that previously drove subscriber growth, directly impacting this quarter's figures. During Disney Plus's launch, the company offered discounted prices to attract new users, but over time, it has adjusted these prices to more sustainable levels, leading to some customer losses. Global economic changes. factors such as inflation and economic uncertainty have led many consumers to cut back on entertainment spending. This directly affects subscription services like Disney Plus and ESPN Plus, as people prioritize essential expenses. Another important point to consider is the growing preference among consumers for live experiences and sporting events, which has increased demand for live streaming services. Disney has sought to enhance ESPN Plus with exclusive rights and live events, but it still faces the challenge of monetizing this segment effectively. Additionally, the impact of artificial intelligence on content production is a key factor in Disney's future. New technologies are revolutionizing how audiovisual content is created and distributed, which could represent both an opportunity and a challenge for the company. While earnings and revenue exceeded expectations, the decline in Disney Plus and ESPN Plus subscribers has raised concerns in the market. Investors are closely watching these numbers because streaming has become a fundamental part of Disney's business model. Examining the dynamic chart, we can see how Disney's stock reacted after the report. Despite strong financial results, the decline in subscribers has put pressure on the stock price. Analysts have noted that Disney needs to find new ways to innovate and diversify its revenue streams to offset losses in the streaming sector. Another factor influencing investor perception is Disney's strategy in international markets. The company has expanded its presence in Asia and Latin America, where there is still significant growth potential for streaming. However, it faces challenges related to regulation and local competition. Disney has managed to exceed expectations in terms of revenue and earnings, but the decline in subscribers to its streaming services has raised concerns among investors. As the entertainment industry continues to evolve, it will be crucial to see how Disney adjusts its strategy to remain competitive. The company faces significant challenges but also has opportunities to innovate and expand its influence in the entertainment sector. Additionally, Disney is betting on diversification. The success of its theme parks, merchandise, and licensing agreements could help mitigate some of the risks in the streaming business. By focusing on different revenue streams, the company might balance the uncertainties in digital subscriptions. Another key factor to watch is how Disney leverages technological advancements, such as artificial intelligence and virtual reality, to create more immersive entertainment experiences. These innovations could open new revenue opportunities and attract a new audience to its platforms. If you enjoyed this analysis and want to understand more about what is happening in the market, I invite you to watch our latest video, where we explain what is going on with Google and why its latest stock correction has drawn so much attention, despite reporting strong earnings. See you in the next video.